Very good morning, friends. So I hope you're all safe and healthy. Well, as a part of the hedge accounting series of lectures with you, I have already done videos till step number 4, and today I'm going to discuss the step number 5. But of course, let me tell you, in terms of step number 5, there are different types of hedge accounting. Now, let me remind you, in terms of step number 5, we are going to discuss the accounting treatment. What kind of journal entries are we going to pass when we are looking at different types of hedge? Now, there are basically three kinds of hedge. If you remember, even in terms of step number 4, one is called a fair value hedge, one is called a cash flow hedge, and one is called the net investment in foreign operation. Now, today in this particular video, I'm going to discuss only one kind of hedge accounting with you, and that is, once you've identified in step number 4 that it relates to a fair value hedge, in this particular case, how would the accounting of a fair value hedge will be done? Let's find out in detail. पास्ट एग्जामिनेशन पेपर्स और मॉक टेस्ट सीरीज की डिस्कशन के अंदर अन अकेडमी पर मैं आपके साथ लेके आ रहा हूँ एक तो फाइनेंशियल रिपोर्टिंग का नवंबर 20 एग्जामिनेशन का पेपर, और मॉक टेस्ट सीरीज के अंदर मार्च सीरीज का आपके साथ फाइनेंशियल रिपोर्टिंग पेपर डिस्कस करेंगे। जो नवंबर एग्जामिनेशन का पेपर है वो मैं आपके साथ डिस्कस करूंगा 24 और 25 को 11 to 12:30, और जो मॉक टेस्ट सीरीज का पेपर है वो आपके साथ डिस्कस करूंगा 26 और 27 मई को। टाइमिंग सेम रहेंगे 11 to 12:30। तो ये समझ लीजिए कि 4 दिन लगातार, यानी 24th, 25th, 26th और 27th आपके साथ डिस्कस करूंगा नवंबर 20 और मार्च 21 सीरीज का MTP 11 to 12:30, और आप इन क्लासेस को अनलॉक कर सकते हैं एब्सोल्युटली फ्री। अनलॉक करने के लिए मेरा कोड इस्तेमाल करना है CAKB10। तो आइए, लेट्स क्रैक इट। So as I said, in terms of step number 5, there are 3 different kind of hedge accounting we're looking for. But today in this particular part, I'm going to discuss only one of the types of hedge accounting, and that is called a fair value hedge. To remind you, as far as the first 4 steps are concerned, the step number 1 is identifying eligible hedged item. The step number 2 is identifying the eligible hedging instruments. The step number 3 is establishing that the hedging relationship qualifies, meets the 3 parameters which we discussed in step number 3. Then in terms of step number 4, you are identifying what kind of hedge accounting is to be applied, whether it is supposed to be a fair value, a cash flow hedge, or a case of NIFO. Now in step number 5, we are looking in terms of how the accounting for a fair value hedge is going to be done. Now, what I've done, I have summarized the entire provisions relating to a fair value hedge in terms of a small little chart, which you can see in front of you. Now, just to, if you recall, one is a hedged item and one is a hedging instrument. Just to recall, a hedging instrument is what instrument is used for the purpose of hedging the risk relating to the hedged item. Now let's first of all look at the accounting in terms of the hedging instrument. The hedging instrument is going to be taken at a fair value, undoubtedly. So let's say, for example, if you are having a hedging instrument, so one thing is very clear, that when you're looking at a hedging instrument, it is to be measured at a fair value. But now the only question what comes to the mind is, where would the fair value changes go? Well, generally it all goes to the profit and loss account, but we need to see, I'm talking of a hedging instrument, but you need to see that hedged item is an equity instrument which is measured at APD OCI, or it is any other hedged item. So remember, when you're looking at the accounting of the fair value changes of the hedging instrument, you need to see that it is hedging which item. Is the hedged item an equity instrument which is measured at fair value through OCI? Then the fair value changes of the hedging instrument as well as the hedged item, both are going to be taken in OCI. Mind the words. I'm saying the fair value changes of the hedged item as well as the hedging instrument both are going to be taken in the other comprehensive income. But if the hedged item is other than equity instruments, then the fair value changes, whether it relates to hedging instrument or a hedged item, is going to be taken to the P&L. And trust me, that's a thumb rule. So if somebody were to say, just tell me in a single sentence that what do you do with the fair value changes, I would say first of all, the hedged item and the hedging instrument both are to be taken at fair value. And the fair value changes will be simply taken to the P&L, with the only exception that if the hedged item is an equity instrument measured at fair value through OCI, then the fair value changes of the hedged item and the hedging instrument both are going to be taken in the other comprehensive income. Now, to give you a little more details about the fair value changes of the hedged item would of course go to the profit and loss account, but where would the corresponding debit or credit go? Because you're going to put the fair value changes in the profit and loss generally, except an OCI in a particular case, but where would the corresponding debit or credits take place? Now for this particular purpose, let's remind you that as far as a hedged item under Ind AS 109 is concerned, that means if I'm looking at a financial asset or a financial liability, it is being measured either at amortized cost, or it is measured at a fair value through OCI, or it is measured at a fair value through P&L, or it could also be a case where it is not a recognized asset or liability, but it's an unrecognized firm commitment. Now, if the hedged item is measured at amortized cost, then whatever fair value changes are there, they will be correspondingly adjusted to the carrying amount of the hedged item. And let's say if the hedged item is measured at a fair value through OCI, then in this particular case, if it relates to an equity instrument, the fair value changes will go to the OCI, and in terms of debt instruments, it will be taken to the profit and loss. So you will overrule the general principles of an instrument with a debt instrument measured at OCI, because without hedge accounting, the fair value changes of a debt investments is going to be taken in OCI, but because of hedge accounting, the fair value changes will be taken in the P&L. So it doesn't overrule the principles in terms of equity instruments, but it certainly overrules the principles what are laid down in terms of, you can say, a debt investments. Now, when it is a hedged item is measured at a fair value through P&L, then all the fair value changes are going to be taken in the P&L. Now, the only tricky situation is that once the hedged item is an unrecognized firm commitment, in those particular cases, the fair value changes would of course go to the P&L, but you're going to recognize a corresponding asset or liability, which for the item which has been designated to be a hedged item. So you're going to record you can say a corresponding asset or liability related to the unrecognized firm commitment with the corresponding changes in the profit and loss. I know it would have been very interesting, if one could take examples on various kind of permutation combinations of, a fair value hedge, but we're going to take a very simple little example to illustrate and elaborate this particular concept. Let's have a look at a wonderful example relating to the concept of a fair value hedge. It says on the 1st of July 2018, X acquired 10,000 ounces of material which is held in inventory. Now we know as per Ind AS 2, inventory is measured at cost, or NRV, whichever is less. But since we're going to apply hedge accounting, the principles of Ind AS 2 will get overruled, and this inventory is going to be recorded at a fair value, considering that this inventory is the hedged item in my example. So we need to definitely record it at a fair value. So I would ignore the principles which are given in Ind AS 2, and I would measure the inventory at a fair value on balance sheet date and even on the settlement. So he says that the inventory is acquired at the rate of 200 rupees an ounce. So for 10,000 ounces, the value comes to 20 lakhs. It says X was concerned that the price of the inventory would fall. So he's more concerned with the fair value fall. And since he's concerned with the fair value fall, it makes sense that we apply a fair value hedge. It says so it entered on the 1st of July, it entered into a futures market to sell 10,000 ounces. So he entered into a contract in the futures market to sell 10,000 ounces at the rate of 210. And then he says on the same date, all the conditions of hedge accounting is met. So one thing is very clear that, if I were to apply back all the 5 steps, I would say the step number 1 in my example, the hedged item is the inventory. And then I go to the step number 2, the hedging instrument is the contract to sell in the futures market. And the third is that yes, all the conditions of hedge are met, so it is certainly a qualifying hedge relationship. And then in terms of step number 4, we identify that in this case, the company is concerned with the price fall. So I would say it is certainly a case of a fair value hedge. So now we're looking at step number 5, that how a fair value hedge accounting would be done. Then he says on the balance sheet date, which is December 18, we given the fair value of the inventory and also given the futures value is 227. Then he says on 30th June, the trader sold the inventory and closed the futures position at the spot price, which is 230 per ounce. So we require to pass entries recording the above transactions. Now, let's, I think, first of all, understand that there are 3 important dates in this particular question. But out of those 3 important dates, I don't need to do any entries on the 1st of July 2018. When they purchased an inventory, they recorded the inventory at a purchase cost. But as far as the futures contract is concerned, the net fair value on the date when you enter a futures contract is nil. So there will be no entry which will be done on the 1st of July. So basically, in terms of accounting, in this particular example, the focus is in terms of 2 entry. One is on the balance sheet date, which is December 18. And one is on the final settlement date, which is 30th June 2019. Now, what do you need to do first of all in this case? You need to consider the fair value changes of the hedged item, that is inventory, and you need to consider the fair value changes of the derivative contract, which is the hedging instrument. Now, in terms of inventory, it was acquired on the 1st of July at the rate of 200 rupees per ounce, and the fair value on the balance sheet date is 220. So there is an increase in the inventory valuation. And this increase will be recognized because, as I already said, that the principles of Ind AS 2 will get overruled because of the hedge accounting, and the hedged item is going to be measured at a fair value. So we record the entry, and that is inventory account debit to profit and loss. So whatever is the increase in the fair value of the inventory, that has been recorded on the balance sheet date. Similarly, the fair value changes of the hedging instrument also need to be routed through the profit and loss account, recognizing the derivative financial asset or liability as the case might be. Now, the company entered into a derivative contract to sell at the rate of 210, and then on the balance sheet date, the rate is 227. So when you calculate the fair value changes, what you do in financial management, you basically apply the concept of squaring off. So when you apply the concept of squaring off, you actually apply the concept that you're going to sell at the rate of 210 and you're going to square off by buying at the rate of 227. So you will sell at 210 and buy at 227. So there is a loss to the extent of 17 rupees per ounce. And this fair value loss is going to be recorded by recognizing a derivative financial liability. So we put the entry profit and loss account debit to financial liability. So what we've done on the balance sheet date, we've taken the fair value change in the inventory, the hedged item, and we've taken the fair value change in terms of the derivative contract, which is the hedging instrument. Simple and straight. Now the same exercise is going to be repeated on the settlement date, that is on 30th June. And we can see that the valuation of the inventory further increased from 220 to 230. So there has been an increase in the inventory at the rate of 10 rupees per ounce. So we're going to put another entry, and that is inventory account debit to profit and loss account. Similarly, in terms of the fair value changes of the derivative contract, the value has become 230. So in this particular case, again, there is a further loss to the extent of 3 rupees per ounce. So you're going to put the entry profit and loss account debit to derivative financial liability. So on 30th June 2019, we simply passed the same kind of entries we have done. One is recognizing the fair value loss on a derivative instrument, which is the hedging instrument. So P&L to financial liability. Similarly, recognizing the fair value change in terms of inventory, that is the hedged item, which is 1 lakh rupee. And now it's time that you also record the cost of goods sold of the inventory and the revenue related to the inventory. Now remember, the inventory is not standing in the books of accounts at 200. Since you have applied hedge accounting, in this particular case, the inventory is standing at a fair value of 230 and it is also sold at the rate of 230. So we do the entry profit and loss account debit to inventory, recognizing the cost of goods sold. And we pass another entry, that is cash account debit to P&L, which is the revenue recognition, which is again at the rate of 230. Now what else? The final thing is, in this particular case, we now also need to consider that there is a derivative financial liability standing in the books of accounts, and that needs to be settled in cash on 30th June 19. So whatever is the net amount, because you recognized a change in the fair value 1,70,000 on 31st December, then another 30,000 on 30th June. So derivative financial liability is standing at 2 lakh rupees in the books of accounts. So you're going to settle that derivative financial liability at a spot rate of 230, and that becomes the entry financial liability to cash, which is settlement of the net balance relating to the financial liability. I know there can be much more comprehensive discussion which can be done on the concept of fair value hedge, but I think the idea is to give you a broader outlook in terms of how a fair value hedge is applied. I'm pretty sure you must be feeling confident after listening to this. So what I'm going to do in the next video, I'm going to discuss the cash flow hedge with you, and of course we're going to take a practical illustration elaborating the concepts of a cash flow hedge. Thank you and bye-bye.